Hi there everybody and welcome back to the stock analysis video. Today I want to analyze one of my personal favorite companies, AbbVie, a spin-off from I believe AbbVie Laboratories. And this company, guys, has a lot of investors and it's actually pretty attractive to especially dividend investors because of the fact that they pay a pretty hefty dividend, which we're going to see in just a moment. But full disclosure, I do actually have this company in my portfolio, which ends up being around 8.1% of my entire portfolio weight. And this company actually pays me a whopping $91.27 every single quarter. So this is a huge position. And in fact, I believe that my average price is around like $105. But seeing that the stock price has actually gone up a significant amount since then, I want to see if the fundamentals actually match this ticker price. So with that said, let's get started with this analysis. Starting off, guys, we're gonna do the dividend summary. The main reason why a lot of people love this company, main reason why I love this company: dividend yield of 3.52%, which ends up being $1.41 per share for an annual payout, guys, of, look at this, $5.64. Payout ratio is around 41.81%. Gonna take a look at the payout ratio in regards to the free cash flow in just 1 second. 5-year growth rate, guys, look at this, 17.71%, which is absolutely incredible. This right here, this kind of 5-year growth rate can pretty much set you good, assuming that they can keep it within the next 5, 10, 20 years, which unlikely, but the fact that they have done it within the past 5 years tells me that they might be around the same ballpark in the next coming years. And just to make things even better, guys, they have consecutively increased and paid out this dividend for the past 8 consecutive years, which is not the best, right? I mean, you have other companies that are aristocrats and kings that have been doing it for 25, 50 years. However, 8 consecutive years is not that bad. Ex-dividend date, guys, is actually on April 13th and payout date is on May 16th. So assuming what we get with the target share prices, this actually might be a pretty good buy at the current ticker price. And of course, they pay their dividends quarterly. Now let's head over to the calculator. Ticker symbol of ABBV. Market cap of $283 billion. PE, guys, of 24.79. Meaning that at the current share price of $160.01, it's pretty much just telling me that it's slightly overpriced according to their earnings, right? I like to buy anything on under 20, 24.79, almost 25. It's a little bit overpriced. However, are you willing to pay a premium, right? Because if a company is going to grow at a really huge amount into the future, you might want to actually pay a premium for. So what kind of premium you're looking to pay, that's really up to you. But we're going to take a look at other metrics and come up with a more accurate share price as to what this company's value actually is. With a dividend yield, as we saw, $5.64, this ends up being around almost $10 billion being paid out in dividends every single year. This is huge. However, in comparison to the 5-year average free cash flow, they're still left with around $4.8 billion left. This is actually a payout ratio in regards to the free cash flow of 67.59%, which is a little bit higher than what I normally like. I like to buy anything under 60. However, it really does depend on a lot of factors, right? This is a pharmaceutical company. You have to take into account what kind of drugs they have in the FDA pipeline, what kind of drugs are in like level 1, level 2, and level 3 for FDA approval and all this stuff. Right now, their main drug is Humira, which actually ended up bringing $20.7 billion in 2021. So it really does depend as to what drugs they have in the pipeline and when Humira is actually going out of patent. Now let's head over to the fundamentals, starting with the net income, guys. 5 years ago of $5.3 billion to 1 year ago of $11.5 billion, increase of 117%. Something very interesting here, guys. Did we see a nice steady increase except for 2 years ago? Now, when you actually come over here to see where the 2 years ago is actually coming from, it's from December 2020, meaning that the 2 years ago mark is actually taken with the brunt of the COVID virus. Seeing that this is a pharmaceutical company, it's pretty surprising that they actually went down. However, they don't make vaccines, right? Their main product is Humira, which explains why they probably went down this 1 year in regards to their net income. But nonetheless, this is still a great positive metric at 117% increase. Now let's move on to the free cash flow, even looking better than the net income. 5 years ago of $9.4 billion to 1 year ago of $21.9 billion, almost $22 billion, guys. Increase of 133% with an average 5-year free cash flow of $14.8 billion. Very steady increase in regards to the free cash flow. We did have a little hiccup right here from 4 years ago to 3 years ago, but nonetheless, 2 years ago they went up, 1 year ago they went up, So all in all, free cash flow is increasing, and if they continue this, they might be able to increase it into the future as well. Now let's take a look at their revenue. Once again, another positive metric. 5 years ago of $28.2 billion to 1 year ago of $56.2 billion, an increase of almost 100% and 99.17%. Nothing really else to say here. It's a positive metric. It's looking really, really good. And something to take a look into the future is that they might actually continue this, assuming that they can bring in more drugs just as profitable as Humira did. Now we need to take a look at the total assets minus the total liabilities. This guy simulates if the company were to liquidate all of their assets, would they be able to cover their debts, and 2, how much money would they have left afterwards? Unfortunately here, currently, AbbVie cannot cover their total liabilities with a negative $7.3 billion. However, guys, even with this, 3 years ago, they skyrocketed to a whopping $34 billion in their assets minus liabilities, essentially skewing all of these numbers up when it comes to the average, as you guys can see right here. But nonetheless, this is pretty concerning, seeing that their assets cannot cover their liabilities, and we may have another spike like this. However, the trend line is essentially going down. You don't want this, because if we fall into hard times, this is a clear indication that they actually might default on a lot of their debts, which is really, really bad. Average assets is around $28 billion. Average liabilities is around $24.7 billion. Average assets minus average liabilities is around $3.2 billion. Now let's come up to the shares outstanding, the silent killer when it comes to investing. Guys, this tells you whether or not the company is diluting you as the investor. And honestly, this is pretty surprising. I was not expecting this. 5 years ago of 1.6 billion shares to today of 1.8 billion shares. That is an increase, guys, on the 5 year of 11.07%. And from the previous year to the current year, so from 2 years ago to 1 year ago, they increased it at almost 1/5%, which is, again, is really, really not good. 11% isn't a lot, but it's also not little, right? It's kind of like in between, at least for me. I would like for them to actually buy this back, seeing that they also have a ton of free cash flow left within their average 5 year free cash flow. And lastly, we got the cash equivalents. And currently, guys, they have around $9.7 billion in cash equivalents with an average cash equivalents of $14.1 billion. Now let's make some assumptions, low, median, high, using 3 different factors: revenue growth, projected share buyback, and required rate of return. For the required rate of return, guys, I'm going to keep it the same, 10% across the board. Revenue growth, I'm going to be using Seeking Alpha's growth tab, looking at the revenue growth year over year and the revenue growth forward, and somewhat making an assumption in between those two. For the projected share buyback, I'm going to use the shares outstanding that we just saw. For the low assumptions, guys, I'm going to say a revenue growth of 5%, predicted share buyback of negative 11, meaning that they will issue shares at 11% within the next 4 to 5 years. And we have precedent for this, right? They have already done it. This actually gives us a target share price, not adjusting for debt, of $172.26. For my median assumption, I'm going to say a revenue growth of 7%, predicted share buyback of negative 10%. This comes out to be a target share price of $186.28. And lastly, for my highest assumption, revenue growth of 9%, predicted share buyback of negative 9%. This comes out to be a target share price of $201.24. Very, very interesting. Now we need to adjust for debt, and clearly they have more debt than they have cash on hand, cash and equivalents. Essentially what we do, we take the cash equivalents and we add then the debt. If they have more debt than cash, this number comes down. If they have more cash than debt, this number goes up. In doing so, we see that for the low assumption, the number comes all the way down to $137.86. For the median assumption, it is $151.55, and from highest assumption, it is $166.17. Now, me personally, I like to add a margin of safety, just so that way we have a cushion, so that we don't overpay for something, because the more you pay for something today, the less returns you're going to have in the future. For my lowest assumption, we would like to buy between $117 all the way up to $131, with a margin of safety of which I forgot to mention of 5, 10, and 15%. For my median assumption, we would like to buy between around $129 and $144. And for my highest assumption, we would like to buy between $141.24 to around $158. Guys, the current share price is $160. I was currently buying this at like $100, and before COVID, or like when COVID happened, and like right after COVID, this was at $80. So if you had the opportunity to just bankload on this, then you are making a ton of bank right now, and especially with that dividend, you got that dividend at a super low yield on cost, which is just amazing. In fact, one of the people that I really like to watch, Dividend Doggo, which I really do hope that you get to watch one of my videos one day, but this man is actually getting from AbbVie around $1,100 every single quarter, which is just insane. I would love to get to that point. Currently, I'm at $91. I was hesitant to keep buying because I didn't know what price it would be at. I am actually pretty comfortable as to buying it at around the 160 because I honestly believe that AbbVie will continue growing. And my highest assumption is falling within the 160 mark, right? And again, it really depends up to you. Because these right here, every single thing that I just did, these are my assumptions. Like I say every video, I'm not telling you guys what to buy. I'm showing you the raw numbers and as to what I would do if I were to buy this company, where I see this company going. This is different than yours. What I suggest is I have this calculator available for free. Anybody can have it. All I'm asking for in return, guys, is like, subscribe, comment. Really does help her with the algorithm. Would love to get to 500 subs by the end of March. I really am hoping. I mean, we're at what, 453? That would be awesome if we could get to 500. I can get my community tab. I can start talking to you guys. That'd be awesome. And again, I'm giving this out for free. All I'm asking is for 2 seconds of your time for something free in return. Now, let's actually analyze this company when it comes to their dividends. Seeing that this company is a huge dividend play, let's just say that we take the average US income at $68,703, bring it to the monthly, which is around $5,725. With the current annual dividends per share at $5.64, if you were to put 1 month, so $5,725 into this company, at this current price, this would get you 35.78 shares, making the annual dividends at $201.80 for the quarterly dividends of $50.45 and a monthly dividend of $16.82, which personally, guys, to me, this is a great thing. I mean, 50 bucks every single quarter, not just every single quarter, every February, May, August, and November, off months, right? Since most companies actually pay out on the 3, 6, 9, 12. This one pays out on off months, which makes it really good and pretty unique, honestly. All in all, guys, as I said, I own this company. I wish I would have bought more when it was at 80. I wish I would have bought more when it was at 100, but I was hesitant. I was afraid. However, looking at my analysis now, I might actually consider buying it because according to my assumptions, this is a pretty decent buy, and I don't believe that this company is going to go away. In fact, I think that they're going to keep growing into the future. I absolutely love this company. And, well, I'm okay with paying a little bit of a premium for this future growth of this company. So I'm actually going to consider buying this, even though the PE is almost 25 and they could really cover their liabilities better. Also, their shares outstanding. But that pretty much does it for this episode. You guys can follow me on my new tech sites of BitChute, Odyssey, and Rumble, where in addition to my stock analysis videos and crypto videos, you'll find exclusives as well. In regards to YouTube, Rumble, and Odyssey, I have a Let's Play channel, link in the description below, so if you want to catch that, please make sure to follow me. With that said, peace out, and be on the lookout for the next stock analysis video.